Welcome to Financial Planning Explained. I'm your host, Mike Menninger, Certified Financial Planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have co-hosting today with me, Nick DeVito, also a Certified Financial Planner, and one of the associates on my staff. Nick, thanks for joining me.
Thanks for having me.
Interesting topic today. It's not even interesting, it's probably boring. I mean, in fact, I always say when I present what are bonds, I always say the first two letters of bonds is B-O, which is the first two letters of word boring. But we actually had someone who had viewed a whole bunch of our episodes and called us up and said, hey, why don't you do an episode on bonds? It's like, all right, well, that sounds like a good idea. Ironically, last night I had a really lengthy meeting with a client, and we were evaluating, or a prospect, shall I say, and we were doing an evaluation of their assets, and I said, you're like 96% stocks. I said, you don't have very many bonds in your portfolio. She says, yeah, I don't know. I don't like bonds. I said, well, why don't you like bonds? She says, because I don't understand them. I said, all right, well, that's good. Actually, it's human nature. I think about when I was in college. The classes I hated were the ones I didn't understand, and I always studied for them last.
Yeah.
Classes I liked, they were fun, they were simple. That's the stuff I understood. But it is also human nature, and we also find this from managing people's money and talking to people. The things that they fear or don't know about, let me rephrase, they don't know about, they fear.
Yep. I mean, like you said, it's human nature. If you don't know, you're going to stay away from it. You're going to avoid it. And I know you said bonds might not be the most interesting topic, but it's a very important topic. And I think because there's a lot of misconceptions out there about bonds. People don't necessarily understand exactly what they are, so they avoid them. So I think it's important that we address that and teach people more about them.
Exactly. So today's episode is, what are bonds? Okay. So what we're going to do is we're going to talk about a lot of different things, like what is a bond, how does it compare to a stock, how they work, what their different characteristics are, how they vary, how they're taxed, and how they fit into a portfolio, all of the above. So I'll let you kick off. What is a bond?
So in very simple terms, a bond is a loan. It's if I am purchasing a bond, essentially I am loaning my money to an entity, a company, a government agency. It could be anything. It's a loan. At the very base of it, it's a loan, they're going to give you give them a set amount of money, and they're going to give you an interest rate, which I know we'll talk a little bit more about later. But I think it's important to note the distinction between a stock and a bond. When you're buying a stock, you are buying equity in a company, whereas a bond, you're loaning a company money. So why would a company issue shares, issue stock versus issuing bonds? Well, they're issuing bonds. They don't want to give up any equity in the company to raise capital. They would rather issue the loans.
Right. Simple. So in other words, if I own stock in Nike, well, I actually own a piece of the company. If the value of the company goes up, the value of my stock goes up. But if I own the bond, I don't own any of the company. All they're doing is I'm lending them money, and they're giving me an interest rate with a promise to pay me back at some defined period of time.
And like I had mentioned earlier, there's different types. Mike's going to dive a little bit into different types of bond, but companies will issue bonds for different reasons. Some want to issue bonds to raise capital to further innovate. You'll have governmental agencies that maybe want to fund projects, I should say. So there's different reasons for companies and entities issuing bonds, and we'll touch a little bit more about that.
All right, so the three different types of bonds basically are your government bonds, your corporate bonds, and your municipal bonds. And I would say government bonds, U.S. government bonds. So those are the governments you hear. Treasuries. Treasuries, by definition, are U.S. government bonds. And they issue bonds, and you can buy them on the open market, often referred to as the secondary market, because if a bond was issued 3 years ago but has a 10-year maturity, it could be bought and sold anytime along the way. Mm-hmm. Same goes with corporate bonds, but instead of it being the U.S. government, it's a corporation, Apple, Nike, whomever, and we're not specifying any company in particular. We're just using them as an example. And then a municipality oftentimes is a nonprofit, okay, whether it be a hospital, toll roads, or building a sewer plant, or whatever the case may be. The difference comes into play is the taxation on it. Municipal bonds, because it's for an entity that is a tax-free entity, it's a tax-free bond. Mm-hmm. So in other words, when I earn interest on that bond, it's tax-free at the federal level.
I was going to say that's
right?
an important distinction.
Which, I tell you, I have to be honest with you, that is entirely backwards in my opinion. I always thought that a U.S. government bond is taxable at the U.S. level. Taxable at the U.S. level, but not taxable at the state level. Mm-hmm. Yet a state bond is taxable at the state level, but not taxable at the federal level. It's backwards.
It is backwards. Now, it does depend a little bit, because if you buy a state-specific municipal bond, you could get the tax-free benefit for that particular state. But if you're buying a fund that has multiple municipal bonds in it, you're not going to get that tax-free benefit. And that's something we'll have our clients take advantage of that are in the higher tax bracket states, the Californias, the New Yorks. For them, it makes sense to maybe go after that New York State municipal bond or that California municipal bond, because you're not only getting that federal tax deduction, you're also getting that state tax deduction. But that's not all municipal bonds. That's only state specific.
Right. There you go. So let's talk about the new issuance of a bond. And let's go with a corporate bond. It works the same way with the U.S. government. They're a little bit more structured, and municipalities are a little bit more specific, but it's a municipality. Let's go with a corporate bond, which is basically a lot of them. So let's say, for instance, we'll take Apple. I'll use Apple as an example again. Apple, large company, and they decide, hey, you know what? We don't like this whole chip manufacturing thing going on with China, Taiwan, et cetera, et cetera. We want to bring manufacturing back home, and we want to build a $1 billion plant. So they need $1 billion. Well, probably picked the wrong company to say Apple. They probably have $1 billion in cash.
They carry a lot of cash.
Bad example. But anyway, so let's say they say, look, I want to borrow $1 billion. What they do is they go issue a bond. Okay? When they issue a bond, there's only two things about it. When does it mature? And what is the coupon? Now, be careful when you hear the word interest rate and yield. They're a derivative of that. The coupon is what it's actually paying. So what do I mean by that? So let's say Apple issues a bond. All corporate bonds are in $1,000 denominations, which means you could buy 1,000, you could buy 5,000, 10,000, 10 million, but they're all in $1,000 denominations. So if it was going to mature in, say, 2045, and I bought a $1,000 bond, they're giving me my $1,000 back in 2045. But what they have also on it is what's called the coupon. And the coupon is generally developed to say, if they're paying in 20 years, what they do is they compare to what the federal government, the U.S. federal government, 20-year bond is paying. And based upon the level of risk associated, will Apple be there in 20 years to pay me my $1,000 back, will determine how much more juice they have to put on top of the federal government rates. So if the federal government rate is 4.5 and Apple's cocky and said, we're a really good company and we're definitely going to be here, they may say, our coupon on our bond is 5%.
And I think what's important to note, and Mike's talking about that level of risk, that's going to be reflected in the credit rating of the company. So your Apples of the world, where they're good, there's a high chance that they're going to be around 20 years from now. They have a higher credit rating, so they can afford to offer a lower interest rate.
That's correct.
Now, if you have ABC company around the corner, a smaller company, and they might not be here in 20 years, or there's a higher likelihood that they're not, they're going to have to offer a more competitive interest rate. Because, anytime you're investing, and a bond is an investment, anytime you're investing, it's always a risk-return proposition. If there's a higher risk, they need to offer a higher rate of return when they're loaning money out to investors.
Perfect, thank you. So they might end up having to give a coupon of 9%. So what happens here now, it's very simple. I own a $1,000 Apple bond that matures in 2045, and I get not 5%, I get $50 a year. That's all there is to it, okay? But bonds vary in price, don't they?
Yes, and I think that's a common misconception that people have about bonds, is that if you hold them, if you buy it from beginning to end, there's variability, but you don't feel that.
That's correct.
The variability comes when you're buying and selling the bonds, and that a major factor with the variability comes into play with interest rates.
That's correct. That's the biggest one.
And I think the easy way to think about it, and how I like to explain it, is, say you buy that 5% bond from Apple, and at the time interest rates were 4.5%. Well, what if interest rates go up to 8%? How do you feel about your 5% bond from Apple when you can get a 8% bond from the government pretty much risk-free.
Right.
You don't feel as good about it, therefore, and it's not as valuable, so the price of that bond will go down because it's not worth as much. Why would I pay $1,000 for a bond earning 5% when I can pay $1,000 and get a bond that's earning 8%?
Right.
And it also works in inverse. Say you have your 5% Apple bond and interest rates plummet and they're now at 1%. Well, your 5% bond is looking pretty good now.
Oh, I like my 5% bond.
And it's now worth more. So I think there's an inverse relationship between interest rates and the value of a bond. If interest rates go up, the bond value goes down. I think a good way to think about it is a seesaw. So on this side we have interest rates, on this side we have the bond value. If the interest rates go up, the value of your bond goes down. Interest rates go down, the value of your bond goes up. So I think that's a good conceptual way to think about it, of that inverse relationship.
And so how much does it go up or down? Well, one thing to take into consideration is if the going rate is 8%, and I have a coupon of 5%, what's going to happen here is the value of the bond is going to drop, and I'm going to pick a number, $700. So it goes from $1,000 to $700. But if you think about it, I am being paid $50 a year on a $700 investment. Okay, that's like 7%. But wait, 20 years from now, I'm getting $1,000 back for that $700 bond. So in fact, what ends up happening is you end up having what's referred to as yield. And the yield on my bond is the $50 I'm earning divided by the $700 that it's valued at is my yield. And then they have yield to maturity, which then takes into consideration the additional value I get. My $700 bond today is now going to be worth $1,000 in 20 years. Well, great, I just picked up $300 in capital appreciation over 20 years is another roughly 1.5%.
Yep, exactly. And I think what's important, because we talked about earlier, the difference between coupon and yield. I think people use those interchangeably and they're very different. To Mike's point, the coupon is always going to be the same. The yield can change when you're buying and selling bonds. Your coupon is always going to be based on the par value of the bond, that $1,000 par value. That's always what your coupon is going to be based on. Your yield is not based on that par value because
Correct.
There's other factors in it. And another important distinction to note is that if you're purchasing a bond and it's less than the $1,000, you're purchasing at a discount. If you're buying it for more than $1,000, you're purchasing at a premium. Think about it. You're paying a premium. If interest rates come down, the value of the bond goes up. You're paying a premium because you're getting that higher interest rate. Inversely, if the value of the bond is lower because interest rates went higher, you're getting it at a discount. So I think the discount versus premium is important to know.
And that could also come into play because then when you sell the bond or when it matures, you're either going to get a capital gain or a capital loss, which is a taxable event at the time. So we kind of made it complex, but it's really not that complex at all. You're basically buying a bond from a company that's paying you a defined coupon every year until its maturity, and then you get your money back. Okay? So the variability is where it comes into play, because if interest rates are on the rise, to Nick's point, if the value of the bond is falling, sounds to me like a crummy investment at the time, right? So you got to take that into consideration. The other thing that comes into play is when is it going to mature? So let's take, for instance, now we're exaggerating here by saying interest rates go from 5% to 8%. They don't go from 5% to 8% overnight. But in our scenario, we're going to say it does. So if an interest rate goes from 5% to 8%, the going rate, and I've got 20 more years to maturity, dude, I'm only getting $50 a year when I could get $80 a year somewhere else. For 20 years, that adds up. That means the value of my bond is going to go way down. But if it's maturing in 2 months, I'm only short one coupon for $30. Mm-hmm. So therefore, instead of it being significantly reduced in value, the value of the bond may only be $970.
Yep, exactly. You're also, in that example, you're also getting your money. You're getting that face value back sooner too.
Right.
That's another factor of it is you're waiting 2 months to get your. You pay I know we used the example earlier. If you bought it for $700, it matures back up to $1,000. Well, you only have to wait a couple months, so they're not going to give you as much of a discount, knowing
Right.
you're getting the full $1,000 back in 2 months versus 20 years.
Right. I'm getting that $50 coupon over this particular period of time, and chances are the bond's value is something like $9.90.
Yeah.
So anyway, that's how they work. So we'll be back, and we're going to talk a little bit more about it at the end of this break. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained as we continue to talk about bonds. Where we left off in the first segment, we talked about the variability. The variability in the price of the bond is going to most notably be based on interest rates. Interest rates are climbing, the value of the bond goes down, like the seesaw, okay? Interest rates are dropping, the value of the bond goes up. But it will be impacted more, and I like to use the arm thing, okay, is if interest rates go down, then the value of the bond goes up, but the length of my arm, you can see that my tip of my fingers go up a lot more than the shoulder. This means it's a longer duration bond. That means a change in interest rates is going to impact it more than if it's going to be up on my shoulder, which means it matures in a shorter period of time. There's another variability of bonds that ties into risk. Okay, people tend to think, oh, well, bonds are safe. Well, okay, maybe not. Okay, first of all, there's risk associated with bonds just because the value could go up or down. Okay, there's reinvestment risk. Like, why would I have this? They say that with CDs. You got a 5% CD. Well, the risk is when it runs out and you can only get a 4% CD, that's a reinvestment risk. But talk about other risks. We've got other risks such as creditworthiness.
Yeah, so we talked about the credit rating earlier, and what the creditworthiness is tied directly to the default risk. So we talked earlier about the big company, the Apple of this world, versus the small ABC company. The default risk is higher with a smaller company, meaning there's a higher likelihood that they don't pay it back. That company has a higher default risk. And we talked about earlier that if you have a higher default risk, you have to pay a higher coupon to get people to loan you the money.
Not to mention, I'm not giving you $1,000 for that bond. I'll give you $600 or $700 or $800 based upon, which, by the way, also impacts, as we noted earlier, if in fact it stays to the end and I paid $600 for the bond and it pays me $1,000 on the back end, hey, that's a beautiful thing, okay? Because I'm getting that capital appreciation. Plus, if the coupon is 6% on my $600 bond, my yield is $60 a year on $600. I have a 10% yield. Yield to maturity is even greater. And hence, that's why you hear of the term high yield bonds and another term that I hate, but it was more common a few decades ago, junk bonds.
Yeah, and that all comes down to the credit rating.
That's correct. Okay, so if you've ever heard of credit ratings for bonds, is you have AAA, AA, single A, triple B, double B, single B, triple C, double C, single C, and D. What's considered investment grade by definition is anything that is triple B and above. Double B is considered junk. And it's amazing that fine line, because if a company is considered triple B and all of a sudden the credit ratings agencies are looking at it and say, hey, your company's not doing so well with cash flow, you're losing business or whatever's happening, and they drop the rating from triple B to double B and they go from investment grade to junk status, that'll kill. Well, say kill, but it'll take a bond value from like 900 to 750, just like that.
Yep. Yeah, it's important to consider that. The credit rating is very important when you're evaluating bonds and determining where you want to go, and it also determines the risk profile that you're willing to take on when you're looking at the credit rating.
Right. Exactly. And then you also were referencing liquidity risk.
Yeah, liquidity risk. So you're agreeing to a loan where you're saying I'm loaning you this money and I'm expecting to get it back in whatever the term of the loan is. The risk you do run is that if you want to sell out of that bond, you have to find a buyer for it. You can't just go to the company and say, actually, you know what, I know I said I was going to loan you money for 20 years, but it's 5 years in and I'd really like my money back. They're going to say, too bad, you agreed to this. So the risk you run is having to find a buyer if you were to try to liquidate your position or
That's
sell
correct.
your bond. You can't just get your money back like that.
Exactly, and that's actually what happened in the global financial crisis. Towards the end of it, and this is after Lehman went down on September 17th, that whole October, November was absolutely brutal. Bonds lost like 30%. And what it was a credit freeze. Now, by definition, it wasn't a freeze, but it was awfully darn cold. Nobody could sell it. Okay, so I have a bond and I want my money. I want to sell my bond. If I've got no buyers, then guess what? I'm stuck with it. Mm-hmm. Or I'm forced to sell it at a much lower price. And that was what actually happened, which destroyed the bond market in the tail end of the global financial crisis, because the example that I was using, boy, it's been a long time, it's 17 years, is I would say if 1,000 people take their Jeep to the market to sell it, and there's 2 people buying, only 2 people got to sell their Jeep. The other 998 went back home with their tail between their legs. They go back the next day, and guess what? They're willing to sell it for less. And so this was going on during the global financial crisis. And what it was a liquidity problem. People weren't able to sell their bonds. And that just caused everything to spiral from there.
Yep.
So we talked briefly about the taxation of bonds. The big difference between bonds and stocks distribute dividends, bonds distribute dividends, but stocks distribute qualified dividends. I like that, qualified dividend, because I always like to ask you a question. Hey, Nick, would you rather pay 24% tax or 15% tax?
I think I like the 15 a little bit better.
Thought so. Better yet, would you rather pay 12% tax or 0% tax?
I like 0. I don't know about you, but 0 sounds pretty good to me.
So basically what happens is qualified dividends are treated the same way as long-term capital gains. Stocks produce qualified dividends that are preferentially taxed. Meanwhile, bonds do not. The interest that you pay on or the tax that you pay on bonds is the same as you're paying on any interest or short-term capital gain. So just one thing to take into consideration.
Yep, with the exception of, we touched on this a little bit earlier, but the municipal bonds, you're going to get that tax-free interest at the federal level. And I think that's something we didn't really touch on, was if a entity knows that you're not paying taxes on something, when you look at those municipalities and they're issuing those bonds, they know that you don't have to pay federal tax on them. Therefore, they're going to offer a lower rate than if you were to go out and get a government bond or a corporate bond, because they know you're not paying the tax on that. So you'll look at maybe a government bond's 5%, a municipal bond could be 3%, because they know that you're not paying that federal tax on it. So that's an important distinction. And when you're comparing municipal bonds to corporate or federal bonds, that's why the municipal bonds have a lower interest rate, because of that tax-free component to them.
Well, if you really want to go down that rabbit hole, so what happens here then is all of a sudden they're going to raise the tax rates. Everybody says, cool, I like those municipal bonds because they're tax-free. And now there's a flood. Remember the Jeeps? You have 10 people bringing the Jeeps and you got 100 people wanting to buy one. Guess what? The price of the Jeeps just went up. So this is now, again, this becomes, as you mentioned before, liquidity, okay? Liquidity and economics 101 is supply and demand. If everybody wants that bond, then guess what? The value of the bond goes up. And oh, by the way, if the tax rates go up, everybody's going to be flooding to buy the municipal bonds because they're tax-free. Everybody floods, the value of the bond goes up. When the value goes up, its yield goes down. Funny how that works. Yeah. All right. But anyway, that's a good point that you brought up. So, so municipal bonds generally will pay a lower price. What's important to understand is, how does a bond fit into a portfolio? And I want to follow up on that from last night, because they said, I don't want any bonds. I'm like, why not? We don't understand them. Well, the reality of it is, while not all the time, basically stocks and bonds react the opposite of each other. I say not the opposite of each other, but when stocks are doing really well, oftentimes that's when bonds are lagging. Why? People are selling their bonds to buy stocks. When stocks are stinking up the joint, people are buying their bonds. And now all of a sudden the bond values go up. You put the two of them in the same portfolio, and what happens is it smoothens out the whipsaw. Now, people hate bonds when the stocks are doing really well, and their bonds are like, stinking bonds are dragging down my portfolio. But watch how fast they start loving their bonds when the stocks are down 25% and their bonds are up 8%. Yeah. Like, oh, I like my bonds now.
And I mean, anytime you're investing, we talk about this all the time, your time horizon is a very important component to that. So generally speaking, if you have a longer time horizon for your assets, you don't need as many bonds in your portfolio. As you're approaching retirement, or if you know you're going to need cash in the 2 to 5 year range, that's where you want to look to have some bonds, not only to smoothen out the portfolio, as Mike mentioned, but provide a level of safety that bonds afford you.
Right. And to the point, bonds don't come without risk. They just have less risk, and we define risk as volatility. Okay? Because a banner year for bonds might be 12, 14, 15%. A really crummy year for bonds might lose 2 or 3. Let's forget 2022. That was an outlier. But the fact of the matter is they got a narrow range which they go up or down. Meanwhile, stocks go up 35, down 25. So risk is measured in the form of a mathematical statistic of volatility. My God, standard deviation. Okay. So the other thing that you'll find with bonds, when you look, you could buy bonds in 2 different ways. You could buy the actual bond, okay? And to your point in the very beginning, if I bought the Apple bond, I paid $1,000 for it. If I'm going to sit on that bond for 20 years, it doesn't matter whether the value goes up or down, I'm getting my $1,000 back. And I'm getting $50 a year, period. But very few people do that. Okay, maybe the institutional investors and stuff like that, but most common people are going to buy a bond fund. And what a bond fund is, it's a mutual fund that may hold 1,000 bonds in it. It's just like a stock fund. So in other words, if one particular bond goes bust out of 1,000 bonds, unless there's a systemic problem, it only impacts your portfolio by 0.1% to have one of 1,000 bonds default.
Yeah, and I think that is one of the misconceptions we talked about. Bonds can't lose value, and people say, well, why do I own a bond fund? How is it losing value? It's for that exact reason. If you have a collection of bonds, the value of them is going to fluctuate. So that therefore the value of the bond fund can fluctuate. That's whereas if you buy the bond in the first example we use, you buy it and hold it, there's going to be no fluctuation that you notice because you're not trying to sell it. Right. But when you're having to buy and sell bonds within a bond fund like they are, that's why there's a price fluctuation in the bond funds.
Right. So there's a measure that you'll see with bonds. Now, one of the things that we talked about from an investment of bonds, if interest rates are falling, that means the value of bonds are rising. That's a beautiful thing, right? You want to buy bonds. In fact, if they're falling and the bonds are rising, I want to go way out on the curve because it's going to have a greater variability. If it's going up, I like variability when it's going up. I don't like...
Not on the downturn.
Right. So there's actually a measure of that, and it's called duration. Okay? If you were to go and look up on any of your favorite websites, okay, and you look up a bond fund, you can look up a term called duration. And duration is a mathematical measure that takes into consideration the yield of the fund, which is all of the coupons, the aggregate of the coupons, and the average maturity. Okay, now what happens is if the average maturity of all the bonds is 8 or 9 years, duration is measured in years, which I don't like because it's stupid, because it's not the purpose of it. But if the average maturity of the bonds is 8 years, the duration is going to be some number less than that. But what the duration means, if you see a duration of 6, what that means is that if the 10-year Treasury yield goes up 1%, the value of your bond fund is going down 6%. If the value of the 10-year Treasury goes down 1%, then the value of my fund goes up 6%. If I had a longer duration bond fund, let's say average maturity is 20 years, I may have a duration of 15. That means if interest rates go up 1%, I'm losing 15% on that bond fund. Anyway, it's not fun.
Nope.
And if the interest rates go down 1%, then the value of my fund goes up 1%. So now you can think about it and say, if you're speculating and believing that interest rates are going to go down precipitously, then actually bonds are a great speculative investment. Not going there with it, but I'm just saying. But the reality of it is, generally speaking, what we use bonds for is to help ballast and balance a portfolio that also has stocks. So that's today's lesson on bonds. Is there anything you wanted to add?
No, I mean, I think we covered it all. We talked about what a bond is. It's a loan to a company or entity. We talked about some of the misconceptions. Bonds aren't always safe. They're not. You're not guaranteed your money every time, especially if you're dealing with a default risk, liquidity risk. There is a element of risk to bonds that I think people don't necessarily consider. We talked about the inverse relationship between interest rates and the value of a bond. So I think we really hit it all today.
Yep.
So.
Yep. Well, it's good. I hope everybody learned something today, and thank you for joining, and we'll look forward to seeing you on the next episode of Financial Planning Explained. You have a wonderful day now. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there's an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.